Hello, welcome back. So, Digital Turbine reported earnings yesterday and the stock was devastated. It crashed down to the ground, 43% down after its earnings report was subpar, and we're going to examine that. I do know that a lot of people are interested in this company. It makes a ton of sense, especially now as it's going down that much. It may be an interesting case. Now, of course, we will examine what happened in the earnings report first. So let's take a look at that. Here's why the market has absolutely hammered the Digital Turbine stock today. Management blames the company's falling revenues on macroeconomic conditions, so the company's revenues are going down, and we will examine exactly how much. And previous acquisitions that the company has been doing aren't really helping to overcome the headwinds, but pretty much add up to the cost that the company is incurring, not really helping them increase the stock price though. And what happened here? So, in the previous quarter that ended in March, net revenues for Digital Turbine were down almost 24% year over year. So that's a pretty steep decline. And as you'll see, for fiscal 2023, net revenues fell 11%. And towards the beginning of the pandemic, the company went on an acquisition spree, so they acquired some other companies here. And even though they did it, again, seeing that the revenues of the company are going down, and seeing also that the forecast of the company is not really that great here, they kind of deters investors from adding more to their portfolio, and a lot of them actually got rid of the stock. Now, the CFO said that he expects that the company will resume the strong growth when the macro landscape improves, and it kind of makes sense because this is obviously a pretty cyclical business, has a lot to do with the market conditions, has a lot to do with the overall consumer activity, because it is advertising pretty much. And for the fiscal quarter for the first quarter of fiscal 2024, that's the guidance. Management is forecasting that Digital Turbine will generate net revenue of 140 to 145 million dollars, and that amounts to a year-over-year drop of 23 to 26%, a pretty steep decline here, similar to the magnitude of the fiscal Q4 decline. A good thing about the company is that their EBITDA is positive, and also they have a positive free cash flow. Now, EBITDA is kind of a way to lie because it excludes a lot of expenses. But the positive free cash flow is important, and they still keep having that. That's a pretty important thing because if the company's stock is declining, you definitely want them to keep making money. You don't really want them to continue issuing shares or getting extra debt. You do want them to become profitable and continue being profitable. But they have had troubles pretty much creating shareholder value. And this is why the stock is down quite a lot. Now, the P ratio, the price to free cash flow ratio, are down, and they're going to be down even more after this precipitous decline. And the company's outstanding shares are higher because the company has been issuing tons of shares. Now, if you were a shareholder during these years, pretty much, it's kind of a bad thing for you. But right now, today, as the stock is down that much, I don't really expect that the company will continue issuing that many shares, as many shares as they were issuing in the past. It doesn't make a ton of sense because the stock price is almost the lowest it has been in like 20 years or so, really, really low. And again, it doesn't really make sense to keep issuing shares, diluting shareholders for this price. Now, if it goes back to 30, 40, 50, maybe it makes more sense, but now probably not so much. And the nice thing is that the key metrics of the company have overall been positive, yet we do expect some weakness in the upcoming fiscal year, and this is already depicted in the current stock price, is the thing. So it's already accounted for, is the good thing for potential shareholders. But the company does have quite a few liabilities and quite some debt here, so it's getting riskier, is the thing. Now, I want to take a little bit of a look and see what the company has been achieving through the years. So from 74 million to almost 747, so almost 10 times the revenue. Even though it's going down for the next fiscal year, this kind of revenue is pretty nice, and this kind of revenue growth has been pretty tremendous. And this has been reflected in the stock price in the previous years, but the current weakness, and because the stock has been so overvalued, and this is what happens, and this is what I have been warning investors for Nvidia, for example, you could see a similar thing play out. The slightest weakness could really annihilate the stock price and pretty much take it to where it should be in the first place. This one seems to be getting devastated at the moment just from the slight weakness that we are seeing in the next upcoming quarters. And the net income of the company has been positive lately. The other thing that you want to examine is the cash flow statement for sure. Kind of tells you that the cash flow of the company has been positive, what I wanted to talk about earlier and what I told you earlier. 61 million is what the company made last previous fiscal year. And the interesting thing to examine is taking a look at the metrics tab here, you will see that the market cap of the company is sitting at about $800 million with about 16. Free cash flow is like a 15, as we saw here, 13.3 in terms of the price to free cash flow. So it's relatively cheap, not super cheap, but relatively cheap here for this company. Again, accounting for what the company is actually doing right now. Now, what about the valuation, which is important here? And it's not really very easy to deduce the valuation because of lots of different problems. The fact that we are not really sure how the company is going to be progressing through the next few years. I have been reading about some, analyst estimates here, what the analysts estimate for the growth of the company in the upcoming 5 years, for example. It looks like we're having a potential for a decline in the next 1 or 2 years, which could be at about 5 to 10% even in some situations, and then a normal pretty much growth of like 15 to 20% in the upcoming few years. So what I'm going to do is I will try a few different scenarios here. The case where the company actually does really bad and has like a minus 1% revenue growth for the next 5 years, so effectively losing about 5% for the next 5 years. And the revenue growth that I'm going to be using for the medium projection is going to be a little bit more positive, but still low, 4%, and the high 8%. And I think that more than likely the company will achieve this. Again, remember, this is a 5-year period. So even if you lose money, if you lose revenue growth for a year or two, you could compensate in the upcoming 3 more years that remain. And the net income margins that I'm going to be using also are a little bit all over the place because the company's decline lately. So I'm going to go somewhere in between these values, like 4 and 10. So I will go, let's just say 4, 7, and 10 here. And the free cash flow margin that I'm going to use, I want to use one that is pretty much unified. So I will go just 100% here, pretty much the same net income margin. And the annual return, 13%. Now remember, all our patrons have access to this tool at myinvestorsheaven.com, and you can try your own projections, because this one, especially these kinds of companies right now, it makes a ton of sense to try all sorts of different projections and see which one works well for what you are suspecting the company will be doing in the next 5 years. So if you want to gain access, you can become a patron by visiting this page or the link in the description box below this video. And if I hit calculate, we're getting a 3.8 for the low, an 8.3 for the medium, and a 14 for the high. This is the best case scenario, obviously, with the current price being at 8. Now, of course, this will be widely different by trying different values, especially for the revenue growth and the net income margins here. And because we are not really that sure what the company is going to be doing, I think the medium one is probably where it's at, like the revenue growth of 4%, net income margin of 7%. I think it's fair for the upcoming 5 years, and I do suspect that the company could actually do better. Again, in the next 5 years as an aggregate, pretty much. I think they will probably do better than this, which is implies a medium buy of 8.3, is where the company is sitting at pretty much today. Now, buying today may be an interesting proposition for somebody who wants to hold for the long term, but I do suspect that it's likely we could see a lower valuation, a lower stock price. I wouldn't be surprised if this actually reaches $5, mainly because of the sentiment. The sentiment is a very, very strong thing, and when the market thinks that the stock is going to go down, they start to hate it, and even if the financials are fair, they hate it more and more and more, and kind of follows a period where there's a downturn, and people just get rid of the stock for no real reason. You see it happening all the time. It's very, very normal in the stock market, and it's good to take advantage of such a situation. When you have a decline of 43%, you typically see some weakness in the upcoming weeks potentially. As as investors, as traders, jump in and kind of follow the similar trend, the trend that you see here, the negative trend in this situation. You may see this company at best being near these levels, or more than likely going down even more. You could see some spikes in some situations. Of course, we don't necessarily know 100% what is going to happen, because it also depends on some potential news pieces coming out of the company, of course. You never know for sure. But generally speaking, this indicates a weakness, like a short-term weakness, and I would probably avoid it right now. But if I was looking to add to my portfolio, maybe I would revisit in a week or two. And if it's sitting at an even lower price or near this price, $8, and I'm fine with it potentially going down a little bit, maybe I could add a little bit to my portfolio. But again, I do really think that this one could even go down more, at least till it gets the chance to do better in the upcoming quarters, if it does better. But I do feel that there is a potential for getting an even better price here based on what is happening right now with the stock price and the earnings report. Do tell me what you think about Digital Turbine. I'd love to hear your comments below. I'd love to read those, guys. So leave a comment below, let me know, and I'll see you in the next video. Bye bye.